AI is making it harder to hire, not easier, harder. Because now every resume is perfectly tailored, every credential is potentially fabricated, and every job posting gets flooded with AI-generated applications that look identical to real ones.
And the company that has spent 78 years building the largest specialized professional staffing database in the world is arguing that this is actually good for their business.
Robert Half International just reported Q1 2026 earnings. Revenue of $1.31 billion, slightly above the $130 billion estimate. EPS of 1.13 cents, in line with expectations. And most importantly, management reaffirmed the target that every investor in this name is watching. Positive year-over-year revenue growth returning by Q3 2026.
The stock is $29.47, down 39% from its 52-week high of $48.54 and down 60% from its 2022 peak. Short interest is 23.6% of float, one of the most heavily shorted names in the staffing sector. And there is an 8% dividend yield on the table, funded from cash at a 178% payout ratio.
We are going deep on Robert Half International today, ticker RHI, the world's largest specialized staffing firm that either catches a cyclical inflection at the bottom or faces a much harder conversation about whether AI has permanently changed its addressable market. Let's find out. Robert Half International operates three segments. The core is Contract Talent Solutions, which places accounting and finance professionals, technology specialists, legal talent, and creative and marketing professionals on a temporary or project basis. Think of it as the white-collar temp agency for professionals who would otherwise make $80,000 to $200,000 as full-time hires. Companies need them for specific projects, transitions, or capacity expansion without committing to a full headcount.
The second segment is permanent placement, which places full-time hires in those same professional disciplines. And the third, and this is what separates Robert Half from every other pure-play staffing firm, is Protiviti.
Protiviti is an internal audit, risk and compliance, technology, and business consulting firm. Robert Half launched it in 2002 by hiring a large cohort of former Arthur Andersen professionals after the firm's collapse. Protiviti now represents approximately 36% of consolidated revenues, about $1.95 billion annually, and operates at significantly higher margins than the staffing segments. That consulting buffer is the reason Robert Half can survive cycles that would crush a pure staffing firm.
The combined model is unusual in the industry. When a client has a compliance deadline, Robert Half can offer both the specialist headcount to staff the project and the Protiviti consultants to oversee it, an integrated solution that neither pure staffing nor pure consulting firms can match. The company is headquartered in Menlo Park, California, with approximately 345 offices worldwide and a registered professional network of over 2.5 million candidates.
The moat here is specialization. While generalist staffing giants like ManpowerGroup compete on volume at thin margins, Robert Half focuses exclusively on white-collar professionals, the cohort where relationships, domain expertise, and the quality of candidate vetting matter far more than scale. And that specialization premium is visible in the gross margin. Robert Half earns approximately 37% gross margins. ManpowerGroup earns 15 to 18% on a much larger revenue base. Keith Waddell has been president and CEO since 2019. He is 68. And here is the detail that makes his story different from almost every other large-cap CEO. He joined Robert Half in 1986 as the company's third employee.
That is not a typo. The third employee. Over the next 33 years, he served as treasurer, then chief financial officer from 1988 through 2019. He ran the finances of this company for 3 decades before taking the top job. He holds a business degree from the University of North Carolina at Chapel Hill.
What that 40-year institutional memory means practically is that Waddell has guided Robert Half through 4 full economic cycles: the 2001 recession, the 2008 financial crisis, the 2020 pandemic, and now the post-pandemic white-collar hiring contraction. He knows the pattern, and his assessment of the current cycle is that it is the longest contraction in recent history, driven by the fastest interest rate increase in 40 years, creating an unusual employment overhang from overhiring in 2021 and 2022.
The most telling thing Waddell said on the Q4 2025 earnings call was about AI. Rather than dismiss it as a threat, he said it is making it harder for his clients to hire, because AI tools are enabling mass resume tailoring and fabricated work histories that make filtering candidates almost impossible without expert help. If that observation is correct, it turns the AI as threat narrative on its head and positions Robert Half as an increasingly valuable signal in a noisy market. Let me walk through the financial picture on Robert Half. The stock is trading at $29.47, market cap approximately $2.96 billion. The 52-week high was $48.54 and the low was $21.83. This stock has moved a lot in both directions over the past year. Beta is 0.84, slightly below the market.
And the valuation?
Price to earnings on a trailing basis is 22.2 times, based on TTM EPS of $1.33. And that elevated multiple reflects the depressed earnings, not the company's normalized earning power. Forward price to earnings is 20.1 times, based on FY26 consensus EPS of $1.48. Price to sales is 0.55 times on $5.38 billion in trailing revenue. Price to book is 2.3 times. At $29.47, you are paying 55 cents for every dollar of revenue, historically a reasonable entry point for a specialized staffing business in cyclical recovery. On the top line, Q1 2026 revenue of $1.31 billion came in slightly above the $1.30 billion estimate. That is a marginal beat, but it represents sequential stabilization from Q4 2025's $130 billion. The year-over-year comparison remains negative. Q1 2025 was $1.35 billion, but the rate of decline is narrowing with every quarter.
And earnings per share?
EPS of 13 cents for Q1 2026, in line with the estimate of 1/3 cents. The Q1 EPS is always depressed relative to other quarters because of an elevated tax rate tied to stock compensation vesting. Management guided Q1 at 56 to 58% effective tax rate versus a normalized full-year rate of 33 to 35%. That tax effect alone explains why Q1 EPS of 13 cents compares to Q4 2025's 32 cents. The underlying business is not that much different. The margin structure is what defines this business. Gross margin of approximately 37% reflects the spread between what clients pay for placed professionals and what Robert Half pays those professionals. Operating margin of 1.4% is razor thin, characteristic of staffing companies at the bottom of the revenue cycle, where fixed SG&A is not yet covered by a recovering revenue base. Net margin is 2.5% on a TTM basis.
And the balance sheet?
Net cash position of approximately $219 million, $464 million in cash against $245 million in debt. Operating cash flow TTM of $292 million, free cash flow TTM of approximately $266 million. These are healthy numbers for a $296 billion market cap company. The dividend costs approximately $237 million per year, and with $292 million in OCF, the company can fund the dividend from operations even at depressed earnings, though with essentially no margin for buybacks or error. Buybacks were essentially zero in Q1 2026. Overall, Robert Half's financial health is watchful. Strong cash position and positive free cash flow, but a payout ratio of 178% that is only sustainable if the earnings recovery materializes on management's projected timeline.
The analyst picture on Robert Half is divided. 7 analysts cover the stock. 2 are buys, 3 are holds, and 2 are strong sells. A notably bearish distribution for a name trading near its 52-week low. The average price target is 33 cents, implying just 2.9% upside from the current 29.47. The range runs from $25 on the low end to $40 on the high end.
The most notable recent action came from William Blair. Tim Mulrooney upgraded Robert Half from hold to outperform on April 21st, just 2 trading days before the Q1 print. A buy upgrade 2 days before earnings is an unusual signal of conviction. His thesis is that the staffing cycle inflection and Protiviti's margin expansion trajectory are underappreciated at current valuation.
Goldman Sachs is at the other end. They maintain a strong sell rating with a $27 price target, raised from $24 on February 3rd, which is the only price target increase they gave while keeping the most bearish rating on the street. The Goldman thesis is structural: AI displacement of white-collar temp roles and the unsustainable dividend payout ratio.
Truist Securities is the bull at $40, up from $35 in February. Toby Sommer's case is pure mean reversion, 0.55 times revenue at the bottom of a cycle for a business with a genuine consulting moat in Protiviti. Barclays and BMO are both hold in the $25 to $36 target range, sitting in wait-and-see mode for the OY revenue inflection.
After the Q1 print, the stock moved modestly. Inline results don't move the needle when the market is waiting for a bigger inflection signal. The William Blair upgrade is the forward-looking indicator to watch. The bull case on Robert Half is a pure cycle recovery play with an asymmetric dividend. The stock is down 60% from its 2022 peak at a company that has survived every recession since 1948. At 0.55 times trailing revenue, you are buying near the historical floor for specialized staffing multiples. And management's guidance for positive YOY growth by Q3 2026, if achieved, would be the first revenue inflection in 3 years and likely trigger a meaningful re-rating.
The bull adds Protiviti as a structural floor. Even in the current down cycle, Protiviti has maintained revenues near $1.95 billion annually and is guiding toward 100 to 200 basis points of margin expansion in 2026. If regulatory complexity and AI-driven risk work accelerate consulting demand, Protiviti provides earnings stability independent of whether the staffing market recovers. And the 8% dividend yield, one of the highest in the industrial sector, creates an income floor that attracts value investors who believe the payout is defensible from cash flow.
The bear case starts with the dividend math. A 178% payout ratio means Robert Half is paying out nearly twice what it earns. The company is burning cash to fund the dividend while generating essentially no buybacks. If the revenue recovery stalls, if Q3 2026 does not deliver positive YOY growth, the conversation shifts from sustainable dividend to dividend cut. And a cut after 23 consecutive years of increases would be a significant negative event.
The structural bear argument is more troubling than the cycle bear. Robert Half's 4 core staffing categories, accounting and finance, technology, legal, and creative, are exactly the 4 categories with the highest near-term AI automation risk. If AI tools allow companies to do with 2 contract accountants what previously required 5, the total addressable market for white-collar staffing shrinks permanently, not cyclically. Goldman Sachs is not shorting the company because they think the cycle is long. They are shorting it because they think the structural story has changed.
The short interest of 23.6% is the quantification of that institutional skepticism. 6.5 days to cover. If Goldman is right, the shorts make money as the company's fundamentals deteriorate. If William Blair is right, the shorts get squeezed when the Q3 2026 inflection materializes. The staffing sector peer set ranges widely by business mix and scale. ManpowerGroup, ticker MAN, is the global generalist giant at $18.4 billion in annual revenue, more than 3 times Robert Half, but it trades at just 0.08 times price to sales. That comparison tells you everything about the specialization premium. Robert Half earns 37% gross margins in professional staffing. ManpowerGroup earns roughly 15 to 18% on a volume model. Manpower is currently running operating losses and executing a $200 million cost restructuring program.
Kforce, ticker KFRC, is the closest pure-play tech and finance staffing peer at $586 million in market cap. Kforce trades at 0.44 times revenue and 17.5 times trailing earnings, modestly cheaper than Robert Half on both metrics. Kforce generates a 25% return on equity versus Robert Half's 10%, reflecting a leaner cost structure. But Kforce has no Protiviti equivalent. Its earnings are entirely tied to the staffing cycle with no consulting buffer.
Korn Ferry, ticker KFY, is the premium talent services comparison, an executive search and organizational consulting firm with $2.86 billion in revenue and a $3.48 billion market cap. Korn Ferry trades at 1.22 times price to sales, more than double Robert Half's 0.55 times. That premium reflects the higher margin consulting and executive search model. Korn Ferry holds $415 million in net cash and has a strong buy analyst consensus with an average target of $73.
The valuation spread is instructive. Robert Half at 0.55 times revenue sits between ManpowerGroup's 0.08 times volume discount and Korn Ferry's 1.222 times consulting premium. Protiviti is the structural argument for why Robert Half's multiple should compress toward Korn Ferry over time as consulting revenues grow, and why it should not compress toward ManpowerGroup's volume staffing trough multiple.
Options data on Robert Half is limited, but the short interest tells the same story. At 23.6% of float shorted with 6.5 days to cover, RHI is one of the most heavily shorted names in the staffing sector. That short base creates a binary dynamic around every earnings catalyst. A strong print can squeeze shorts and amplify upside, while a miss can accelerate selling.
Implied volatility on June 2026 options was running near 46 to 47%, heading into Q1 earnings, above the trailing 12-month realized volatility of approximately 36%. That gap signals the options market was pricing in meaningful event risk around the Q1 print. With Q1 results in line on EPS and slightly ahead on revenue, the event risk is absorbed, but the underlying short positioning remains elevated until the Q3 2026 YOY inflection either validates or invalidates the recovery thesis.
The William Blair upgrade 2 days before earnings is worth noting in this context. Upgrades right before earnings are relatively rare from research analysts who have sector-wide institutional relationships. It suggests their conviction on the setup was high enough to publish before the print, rather than waiting for post-earnings clarity.
The insider picture at Robert Half is quiet and slightly concerning at the margin. No open market insider purchases in the past 6 months. The only open market transaction was from Director Dirk Kempthorne, who sold 6,505 shares at $28.87 in late October 2025, roughly $188,000.
CEO Waddell did receive a large compensation grant of 177,276 shares in March 2026, with approximately 33,000 shares withheld for tax purposes. But plan-based compensation grants are not conviction purchases. They reflect the company's executive compensation design, not Waddell's personal view on the stock price.
Zero open market buying at a stock that is at $29.47, well above the $21.83 52-week low, but still 60% below the 2022 peak, is notable. If insiders had strong conviction that $29 dramatically undervalued the business, you would expect to see some purchasing. The absence suggests management's optimism about the recovery is measured rather than emphatic. It is not disqualifying, but it is consistent with an honest cyclical bottom rather than a confident inflection call.
The top risk on Robert Half is the dividend. At 178% payout ratio, the company is paying $2.36 per share annually against TTM earnings of $1.33. The cash position covers it for now. $464 million in cash provides multiple years of runway at current burn rates. But if Q3 2026 does not deliver the promised positive YOY revenue growth, the payout ratio discussion moves from uncomfortable to urgent. Watch for any language on dividend sustainability and management guidance.
Second, the AI structural risk. Waddell's observation that AI makes hiring harder for clients is clever framing, but it does not fully address the displacement question. If AI reduces the total demand for contract professional headcount, not just makes individual hires harder to verify, the denominator of Robert Half's business shrinks permanently. Track quarterly contract talent placement volumes for any sign of structural volume decline that persists even as the economic cycle recovers.
Third, the Q3 2026 revenue inflection. Management has committed to positive year-over-year revenue growth returning by Q3 2026. That is now the binary catalyst that either validates the recovery thesis or forces a fundamental reassessment of the timeline. Any quarter between now and Q3 that shows acceleration in the rate of decline is a serious red flag.
And fourth, short interest mechanics. At 23.6% short, the stock is vulnerable to violent moves in either direction. A positive inflection could trigger a squeeze that takes the stock well above any intrinsic value estimate. A negative development could accelerate selling pressure beyond what fundamentals would warrant. The short interest is a volatility amplifier, not a directional signal on its own.
So where does this leave us on Robert Half after Q1 2026?
Operationally, the quarter was stable. Revenue of $1.31 billion came in slightly ahead of consensus, representing sequential stabilization from Q4 2025. EPS of $0.30 was in line, impacted by elevated Q1 tax rates from stock vesting. Management maintained its Q3 2026 return to growth guidance. Protiviti is on track for its margin expansion targets. No positive inflection yet, but no deterioration either.
The stock is $29.47. The average analyst target is $30.33. Essentially no implied upside at current levels. 2 buys, 3 holds, 2 strong sells, an 8% dividend yield that requires $237 million a year to sustain at a 178% payout ratio, short interest at 23.6%, and one pre-earnings analyst upgrade from William Blair that is now either prescient or premature.
The metric to watch is the weekly same-day constant currency revenue trend within Contract Talent Solutions. Q4 2025 was the first positive sequential reading in 3 years. If Q1 2026 confirms that signal and management raises its confidence on the Q3 inflection, this stock has significant room to re-rate toward historical multiples. If the signal stalls, the dividend payout conversation accelerates, and the bear case gets louder.
The honest framing on Robert Half is this. The case for the stock is that you are buying a 78-year-old business near the cyclical bottom, at a PS multiple that has historically marked durable entry points, with an 8% yield as your carry while you wait. The case against is that the bottom might not be a cycle bottom. It might be the beginning of a structural re-rating driven by AI. Q3 2026 is the quarter that starts to answer that question. We will leave you with this from CEO Keith Waddell. AI is actually making it harder for our clients to hire due to mass resume tailoring and fabricated work histories. We help them cut through the noise.
AI making it harder to hire. For a company that has been helping people navigate the labor market since 1948, that is one of the more ironic and potentially powerful competitive advantages in the staffing sector right now.
That's going to do it for this episode of Charged Alpha, your S&P 500 stock encyclopedia. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.